Thank you, Lior, for coming on Tech Renaissance. It's absolutely a pleasure to have you here, and I really appreciate you accepting my invite to join.
Definitely, no problem at all.
So Lior, to start off with, if you could give us your background about the Wealth Research Group and what exactly it is that you do. I myself am a subscriber, but I want to give the audience a bit of a background, and then we can dive into essentially the global macro analysis, interest rates, bonds, equities markets, and essentially jump from there into some important potentially dollar disruptive changes that could be occurring in terms of new energy bonds that are coming online. And then from there, I'd like to discuss digital assets, primarily cryptocurrencies, and see what the implications are. And lastly, we'd like to get your advice on how to manage a portfolio in such dynamic times where traditional allocation may not give the same yields as in the past. So I'll start off with your background, and then we can dive into subsequent questions.
Well, I think Wealth Research Group, it was officially launched at the beginning of 2016, but the actual idea to reach out to a larger audience, it started probably when I was very early on in my life. My father was bankrupt when I was 13, and it forced me to get started on working. I started babysitting. Actually started assisting coaching in basketball, but the parents that were there asked me, "Hey, can you watch over my kid in later afternoons?" And that's how I started saving money. So that habit of saving started back then, and obviously looking back at it, the fact that my father went bankrupt, it forced me as a kid to start thinking about saving money instead of spending all the allowance. Which could be a good habit to develop early on, because that most kids do not have like a bank account. But I opened a bank account at 14 for myself, and signed a waiver with the banker, and my parents had to actually sign it so I can start investing the money myself. Because what happened was, started babysitting and assisting coaching and all that kind of stuff, and ended up with like $10,000 in like a year's time. So I said, okay, what do I do with it? And I asked my grandfather, and he gave me a Warren Buffett book and a Peter Lynch book. And it's the grandfather, not from my father's side, but from my mother's side.
Right.
Anyways, at 16, so that's like 18 years ago, I started investing. It was right after the dot-com bubble, and so companies were actually, and stocks were actually cheap. And I started investing in China. It wasn't my own brilliance. It was partly, just speaking with other people and seeing what is the next big shift in the world. And China was it. So, and that's got me started on commodities investing, etc. But the core has always been this dividend, we call them wealth stocks, but it's dividend raising companies that are able to operate and increase their profits and their margins year in, year out, rain and shine, no matter what the interest rate is, no matter who's elected to be president, no matter all financial conditions are fine with them, because they have such a great competitive advantage, a management team, etc., that they can grow your wealth passively over the decades. So that has always been the core. And since I started at 16 with, at 13, basically working, I've never been employed by other people. So it's always been about entrepreneurship. And I had I had 5 businesses that didn't take off in my early 20s, and then a breakthrough. And so what happened to me is in 2009, I moved to the States because I wanted to get into real estate when America was on sale, and did very well. Sold that business in 2013, and started a boutique fund right after that with about 20 clients. And when we liquidated that fund in 2015, it was with the idea that, hey, I want to now share that part of my life, the last 15 years of my life where I've been a full-time investor and entrepreneur, with a larger group of people, because on December 15th, 2015, the Fed started raising rates for the first time in years, and the tightening period had begun. and I said, this is the perfect time to let people understand that the times are changing, and wealthresearchgroup.com was the labor of love, that child that was born out of my need to share my research, to let people know what's going on, in my opinion, and let them decide for themselves what they want to do with the information. And the website itself, the Wealth Research Group website, is full of a wide array of special reports. And so on the top menu, that's where you can kind of see the things that we're covering most. But yeah, the best way to make sure that you're up to date with what we do is the newsletter, definitely. And that's where my mind is at with regards to how to share the research that we do. Yeah.
Absolutely. Well, I'm going to put the link of your website, obviously, in the link below. And
yeah, no problem. Thanks.
So LIOR, I'd like to dive into the economy, and I personally have been perplexed since 2008 in terms of where things are going, because all traditional correlations, to me, especially in the last 2 years, everything has become a bit of a haze, and investing with logic, at least in the traditional market sectors, such as your equities markets, your bond markets, it's become increasingly difficult to harvest yield. And so I wanted to get your take to begin with on interest rates. We're going to be, it looks like the Fed is going to be raising rates successively this coming year. What are the implications of that for the average investor? Where do you see things going on this economic transition? I actually saw your newsletter today where you did this phenomenal expose on the transition from World War I and the fact that World War II was such an important event. So I'd like to kind of get your take on that and just educate all of us in terms of what's going on.
Okay, well, let me condense this into basically one answer. So the World War II was very important for the way that the economy is currently operating, because about 1 year before the war ended, it was already clear that Germany is losing the war, and that at some point it will surrender. And there was a very critical time to make sure that there's going to be continuity. So after the war, we won't experience markets that are shut down, banks that are shut down, and that there's going to be a new way to move forward. And what that new way was a dollar reserve currency backed by gold. It's called the Bretton Woods Agreement. And the idea was that the U.S. is the new superpower. The UK was diminished. Its decades-long colonial ruling had made it very economically weak, and the war obviously decimated it in terms of construction and infrastructure. So it needed to rebuild. The U.S. was unarmed and by actual bombings, except for Pearl Harbor, and so it was in a great place, in a great situation financially to take the lead. Obviously, not all countries agreed to that, but the majority did, and that's how this new kind of monetary system, where the dollar takes the lead and all the countries are subject to it, came to be. That has positive ramifications and negative ones. The positive ones is it gave the U.S. a very strategic role in the world going forward, and it birthed this prosperity of their middle class. But they made a lot of policy mistakes, and in the 60s they got into costly wars because of their this role that they took on to be more of a policeman of the world. Mm-hmm. And so in 68, 69, it was already obvious that they are not able to sustain this 35-to-1 ratio of dollars to gold. And a lot of countries wanted to exit the Bretton Woods Agreement. And so instead of that, we had Nixon cutting the link between gold and the dollar, and essentially putting everyone on this new financial system, which nobody agreed to, but it's the way it is right now. It's called the fiat monetary system. But the U.S., in terms of the federal government is in a situation where they cannot stop having deficits. The deficit is part of the program, and it's part of the way that the world is built right now. So it's only a question how this will unwind. And what happened with the U.S. is starting 1982, they started cutting interest rates. The 70s was a very difficult time for them in terms of inflation. It got to about 14% for the CPI, and the Federal Reserve actually had to raise interest rates to about 20% on the Fed fund rate in order to stop this, to stop inflation from becoming a pandemic in society and the economy. And what happened at that point was the U.S. was still, Faisal, the biggest creditor nation in the world. It was very wealthy. It wasn't like now where it's the greatest debtor nation. So when they slashed interest rates in the United States, they fueled the economy. The stock market was able to roar for 18 years straight from 1982 to 2000. But interest rates kept on going down. It was a phenomenal time to be a bonds investor. Now we're at a point where this is ending. So after about 35, almost 36 years of lower interest rates and higher bonds prices, it's starting to shift. Borrowing costs are on the rise, yields are on the rise, and what that means is that the bond market is in a very fragile situation. Now, if you're asking how does this affect investors, even if you don't own bonds, this affects you a lot. But let me explain first of all what happens to people who do own bonds. So the big thing with bonds is, especially with the treasuries, is that $6 trillion, $6.3 trillion worth of treasuries are owned by entities that are outside the U.S. So not by any U.S. corporation or by citizens or by hedge funds, pension funds. They're owned by other governments. Now, bonds pay a yield. Now, let's use a very simple example, and I talked about this on other shows in the past 2 weeks. Let's use a simple example where you decide to own, to buy, or to loan the U.S. government, I should say, $100,000, and you buy $100,000 worth of 10-year bonds. The 10-year bond is paying about 3% today. Let's round it up. So right now, in 1 year, you'll get a coupon payment of $3,000 a year. That's the interest payments that you're going to get from the U.S. government. Now, 1 year from now, if they keep raising rates at 25 basis points, and let's say four raises, then the Fed funds rate will be 1% higher. Let's assume that it's going to cause the 10-year bond to rise by 1% as well. So it's going to yield 4% instead of 3%. So that means your coupon payments have gone to $4,000. Now, what does that mean? That means that if a new bondholder comes to the market and he has the choice between buying the bond off of your hands, the one that pays 3%, or buying a new bond that pays 4%, and he has $100,000, will he buy your bond for $100,000 and get paid $3,000 a year in interest payments, or will he invest his $100,000 and loan the government money now at 4%? Well, of course he'll do it for 4%. But if you want to sell him your bond, you can say, hey, well, listen, if I sell you my bond for $80,000 or for $70,000, you'll buy it, because $70,000 times 4% is actually that same yield amount. It's the same interest amount. So
of the bond.
Yes, the price of the bond, the face value of the bond is going to diminish substantially. Now, if you couple that with the fact that inflation is rising, then your interest payments, your fixed income payments, the coupon payments, are also going to diminish in purchasing power. If you buy a 10-year bond and inflation is about 3 to 4%, then basically you're essentially not only losing money on the face value, but you're actually not gaining anything in terms of meaning with inflation. So your purchasing power in 10 years, you're still going to get $4,000 on your bond, but it's going to help you pay for stuff that today costs $2,000 or $2,500. So higher inflation rates and higher bond yields kill prices for bonds. And who are the largest owner of bonds? It's governments, foreign governments, which creates a geopolitical event, a geopolitical conflict with the US, and pension funds, where 30 million people in the US are about to enter the retirement phase of their life. It's already 51 million today. It's going to be 80 million in about 10 to 15 years. So they're relying on their bonds portfolio. And the central banks themselves, they're the biggest bonds holders. So who's going to bail them out when their portfolios goes down 20, 25%? So this is a global situation, a very problematic situation. And if you really think about it, Faisal, it's the only market that hasn't seen a bubble pop in it in the last 30 years. We're seeing tech, we've seen real estate, we've seen the stock market, we've seen cryptocurrencies even suffer a huge, huge loss. The bond market has not suffered any huge loss in the last 35 years. Even the Australian real estate market, which has been in a 60-year bull market, has seen it stop. The bonds market is the biggest market in the world that hasn't seen any meaningful price correction in decades. And so what's going to happen is if you lose 20 to 30 to 40% of your face value, and you were relying on that face value so you can sell that mature bond to the market back, and you can't, but you want to still retire on time, you're going to need to sell a real estate holding, or you're going to need to sell some stocks. That puts pressure on the entire economy. Mm-hmm. And when that happens, usually people move on to other asset classes to offset what's going on or to hedge. So they're moved to asset classes that are either uncorrelated or inversely correlated with rising interest rates and higher inflation. And we wrote about this whole situation and what to do instead of owning bonds at wealthresearchgroup.com/bonds. And you can see kind of where historically has been the best place to move your portfolio instead of bonds in this type of environment of rising interest rates and rising inflation levels.
Excellent. That was an excellent overview, by the way, because I've always looked at correlations, but generally when I have discussions with people that aren't familiar with the relationship of interest rates, bonds, and the entire monetary system and how it impacts them, then they just like you said, whether you own bonds or not, this is going to impact you, and this is, in my opinion, sovereign debt potentially that we're about to face.
In terms of the equity loss, Faisal, you can, if the bonds market goes down about 30 to 40%, the equity loss would be about $9 trillion, more than homeowners lost in 2008. It's a huge event. I don't know if it's going to be an overnight event, so it's not a systemic situation where it's going to happen right now, but in the course of a few years, there might be a point where investors say, okay, we're fed up, enough is enough, and it's going to cause that panic.
And when you see central banks across the board, especially the reserve currency central banks, such as your Eurozone, Japan, the US, you see generally the central banks, as you said, are actually holding so many assets on their books that, that's another concern on its own as you're raising these. I think the Eurozone is simultaneously raising rates as well, along with the Fed. And so I wanted to get your take on, what's the correlation between rising rates and the equities markets? What traditionally should be, the Dow just keeps going up, perpetually. And at some point, I start to wonder, are we gradually going into hyperinflation in a Venezuela-like situation, or is this something more, something different?
I know that in the U.S. there's a huge audience that are scared of hyperinflation with the U.S. dollar. The risk of runaway inflation in the U.S. is quite contained. For the U.S. to even suffer 4 to 5% official inflation is problematic. If they suffer 10% inflation, it's horrible. And so the U.S., remember, the U.S. dollar is 71% of the world's currency supply overall. It's a huge, huge currency in terms of its weight. So if 7 out of every 10 currency units in the world are US dollars. 50% of them are held in accounts outside the US. So for the US to suffer inflation, it means that a lot of money needs to go back into the US banking systems from outside the world. For that to happen, it would require the US to stop being the reserve currency, because otherwise all these other nations, they need to hold US dollars in their accounts. It's not like they're dumping it like Venezuela's citizens were dumping their currency, right? So the risk of a huge runaway inflation with the US dollar is not as big sometimes, and I know a lot of people are very core gold-oriented people, and they almost want to be vindicated and feel like they're right about the US dollar. It's a very problematic currency. It's in a very dire situation, but a currency can be in a very rough situation without suffering hyperinflation, runaway hyperinflation. The US dollar has lost 95% of its value, even more, in 100 years. So it's losing about 1% a year on average. But overall, if you take that period between 1971 and today, where it's lost about 75%, it's losing about 1.7% a year. So that's the way it's built, because it's owned by so many different entities that it's not concentrated in one little country like a Venezuela type event.
Sure.
And so many people have, or many governments have, a lot to lose if their dollars become worthless. So all the actors know what they need to do in order to make sure that runaway inflation doesn't occur. But obviously nobody likes what the US government is doing in terms of running deficit spending and higher inflation, etc. But the real origin of general inflation, and I'm talking not inflation in your tuition or your entertainment bills or your insurance, but general inflation across the board, everything that you buy is now more expensive. It originates with higher wages. If higher wages are across, if employers are raising wages across the board in the US, in an economy where about 2 to 3% of your money is being saved and the rest people spend, that can create a velocity of money. That can create surprise inflation. Surprise inflation is what nobody wants, no investor wants, and no CEO running a company wants, because he can't figure out costs going forward. He can't figure out his margins going forward. Doesn't know if he needs to expand or contract, hire or fire, etc. This creates a lot of uncertainty. Very bad for equity prices. Now, because that's happening in the U.S., wages are rising, especially in Middle America. So you're talking like Michigan, Oklahoma, Texas, these inner states that haven't been the main states to flourish after the 2008 situation. We saw, Miami, New York, Los Angeles, California becoming rising first, but now the biggest GDPs are in Middle America. So they're starting to see their wages rise, and when their wages rise, more disposable income comes, coupled with tax cuts. There's certainly inflationary pressures in the US. So to curb that, you need to raise interest rates. When you raise interest rates, you make the bond yields more attractive than the S&P dividend yield. Mm-hmm. And so for a lot of investors and for a lot of institutions, that's what they want to know. For instance, pension funds, they care, hey, if I can get the 2-year bond or the 5-year bond to yield more than the S&P 500 dividend yield, I'd rather take a bond. And so rising interest rates are like gravity for stock prices. Stock prices start to go down when interest rates rise. Mm-hmm. And that's what you're going to see in the US. The PE ratios of the S&P 500, the NASDAQ, and the Dow Jones are quite elevated. If you normalize them for interest rates, they're not in a bubble territory yet. They're very high in terms of historical P ratios, but if you normalize it to where it's to the low interest rates environment that we're in, they're about fairly valued. So I do see the stock market heading higher from here. The major indices heading higher from here. I won't be surprised if we still see a 50% rise. For example, with the Dow Jones going from 24,000 points to 36,000 points, and the Nasdaq outperforming the S&P and the Dow. But as you continue raising interest rates, you're creating a situation where it's less and less attractive to own stocks over bonds in terms of yield, and therefore a lot of money will move into bonds. When bondholders will see that, hey, I love the yield, but I'm getting squashed by inflation, then bondholders will start to move into real assets like precious metals, like commodities, and that's going to fuel a real bull market for that sector. And that is something that we're anticipating with Wealth Research Group in a major, major way. A bull market with real assets led by gold. So I know I gave you a long answer, but I know your audience is, I've seen that the audience is incredibly sophisticated. So I want to make sure that I give them the full answer. If you want to know personally how I'm doing, what I'm doing is, so you can go to wealthresearchgroup.com/bonds and see how I'm moving. I don't personally own bonds today, but what bondholders should do to move their money into other asset classes that are yielding high yields, so 8% to 12% yields, and are actually favorable in these kind of times. And you can go to the wealthresearchgroup.com/portfolio, where it's actually my personal allocated model for 2018. So it's full access to what I'm personally doing.
Excellent. Yeah, well, and I'm sure people are going to check out your website, specifically the link that you identified. And LIOR, so I mean, I do understand what you're saying, because you know, a lot of pension funds were moved into risk assets with such low rates, and I think they're definitely going to rebalance when they see higher yields in bonds, just to, you know, shave off some risk off the table and still achieve their you know, target rates or target returns and yields to meet their obligations.
They won't.
They won't. Sorry, what?
They won't be able to. The pension funds are targeting about 7.8% a year, and they have been underperforming that for almost 15 years. They have a major shortage, and that's why I'm saying that people will need to understand that retirees will need to understand that their pension funds have let them down, and they're going to start selling. You know, in America, there's about 2 million homes that are vacant. People own 2 homes or something like that.
Right.
That's going to be that excess inventory will get sold, and millennials are going to have a hard time bidding the prices that baby boomers will want for these homes. And that's why I see, and that's a new theme. I'm actually going to reveal this for the first time on your show here, but I do see America becoming Asianized. And Asianized means that Asian buyers will come in, buy these homes in the U.S. For cash, because they're going to be very cheap, and you're going to see Asian landlords that are remote landlords, and they're not going to live in America, but they're going to own like 30 to 40 homes, and you're going to see a lot of renter environment in the United States, where this is something that we haven't seen in the United States. We obviously see it in Europe, where somebody, a family owns like 40, 50 homes in Paris and or wherever that they inherited over the decades, right. And most people are renters. You don't see that as much in America, but I think America is going to get Asianized, as well as in the real estate market, as well as in the stock market. I see a lot of companies that are U.S. based that are going to be acquired by Indian companies and Chinese companies in the next 2-3 decades here. It's a huge shift. It's one of the biggest shifts that we'll see going forward.
And there's a demographic shift happening as well, in terms of millennials being more transient and you know, not as keen to for home ownership as the previous generation. So I think a combination of that combined with, you know, just cash buyers coming in, as you described yourself, it makes sense. There's logic to what you're saying. So LIOR, where do gold prices heading in the near future? I mean, you mentioned that, you know, there'll be a shift towards real assets and precious metals. And there's gold bugs out there that have been predicting all sorts of, prices for gold, which, again, I agree with you. I do believe it's a process, and it's a gradual process, and it's not an event. So I wanted to get your take on precious metals prices, where you see them heading.
Well, important to remember that gold has outperformed the S&P 500 this century. So in the past 18 years, if you own gold, you're doing better than owning the index. And that is something that most people never achieve in their lives. So to do that for 18 years straight is a phenomenal achievement. Most people, 96% of investors, do not beat the index. So for 96% of people, the best thing that they can do with their money is just own the S&P 500. That's what they can. That's what they should do, and save all the hassle and the headache of trying to beat markets, because it takes a lot of independent thinking and becoming a very good investor. So if you don't have the time to do that, you're most likely best off just buying an index fund, because index funds have performed very well over time. 7.6% a year is phenomenal. And in the course of your life, in the course of a 40-year career, that's going to compound your money to where you make about 40 or 50 fold. So if you start with a nice chunk of money, you're going to end up with a millionaire. And it's where that book, The Millionaire Next Door, comes from. It's just gradual compounding of your wealth over a long time. But for me, look, I'm 33. I am not subscribed to that plan of retiring at 65. I want to be a wealthy man and live on a high standard now. And so my thought process is very different than just staying with the index funds. And that's why my allocation is a bit different than most people. And I invest in private businesses and in early stage businesses, etc. But gold is important to remember that gold is not a long-term investment. Gold ownership, the physical gold, is not a long-term investment that creates wealth. It can sustain wealth or store your wealth instead of saving in a fiat currency. If you go back to 1802, so you go back, like 215 years, 216 years, every ounce of gold in terms of purchasing power, or every dollar invested in gold, is now $4. Now, that's nothing. In 215 years, to make 4 times your money, it's nothing. Right. Gold is phenomenal as a trading vehicle in certain situations. And therefore, if you want to become wealthy over the long term, if you have a long-term plan, if you have a 40-year plan, then owning gold will not be that amazing environment that you want to be in 40 years from now. When you want to sell your gold ounces 40 years from now, you're not going to become wealthy by that. Alternatively, if there's a situation where inflation is a problem or there's a currency crisis, gold ownership is a must. And therefore, it's the way I see it, I have calculated my lifestyle burn rate, monthly burn rate, and I took 24 months and I essentially bought in US dollars terms, I bought gold ounces and silver ounces to meet that. And I feel like that is enough. 2 years worth of spending power in ounces of gold and ounces of silver. And that for me is enough. If I see that there's a situation where it needs to increase, then I'll increase that. But I don't see a situation where I'll take that down. Now, I don't plan to sell it. So selling gold and silver means that you're basically saying the situation in the world is so horrible that people only accept buy gold and silver. They do not accept easier, more convenient means of payment. Mm-hmm. So obviously the world is much more modernized now, and carrying around gold and silver is not relevant. It's not something you want to do. So if you're actually selling it, it's because people only accept that, and that's a very horrible situation. So gold and silver are your insurance policy for a cash situation or for a catastrophe situation. The rest of the time, gold and silver should not be your main focus in terms of building wealth. So,
Absolutely.
you know,
It's an
I
insurance
think,
policy at the end of the day, right? As you said, against a major monetary event. And, you know, a small allocation in your portfolio is probably ideal versus converting all your liquidity into gold and silver, because it's not easy to convert back into fiat. I mean, it's easy, but it's also physically to move back and forth is not easy.
oh no, it's very easy. You can sell selling your vault storage is very easy. If you keep it in vault, it's very easy. If you want to sell it back to a dealer, it's very easy. It's not that worries me, that logistic part. It's more that people need to understand that gold and silver are not wealth vehicles, and they shouldn't hope for the entire world to collapse in order to become wealthier, because that normally doesn't happen. Think of how many times that has happened in your lifetime. You'll see that it's zero.
Right.
Most of the time, the world just it refuses to end. Right? We've been through everything in the 20th century, and yet, you know, the stock market has been an insane wealth vehicle. And I know people think it's rigged or it's a casino or whatever, but that is something you need to let go of, that thought that even if it's rigged, even if it's manipulated, it's fine. You can still make money at the end of the day. So with all of this manipulation and all the different opinions and all the different consensus regarding what the stock market is, at the end of the day, a well-managed company that has a phenomenal product or service and is able to conserve capital in the right way is a great investment overall. So let's put that to rest. But if you want to use the precious metals arena to create wealth, your only way to do it is using the mining sector itself. Now, since it's absolutely risky, very volatile, you need to make sure that you know how to short ETFs of gold while you dollar cost average your favorite names, and you need to know a lot of stuff. The best way to do it is probably to stay with the royalty companies, because the royalty companies have outperformed no matter what happens in the gold sector. So we wrote a special report about the top royalty companies at wealthresearchgroup.com/royalty. The thing about the royalty companies, though, if you read my report, is that you see that they're very expensive usually, Faisal. They have a premium price to them. So it's you need to really find them after they go through a correction. Otherwise, you're overpaying for them, probably going to have mediocre results going forward. Personally, I believe that the best way to do it is find the best management teams. Focus only on their companies. Know everything you need to know about their companies. Everything. I mean everything, Faisal. Know them like it's like they're your partners, and then stick with them, because you know these people have previous successes. They know what they're doing. They can manage the brutal cycles of the ups and downs. And in 5 to 10 years, not a month, not 2 months. Sometimes it happens, right? Sometimes there's a rally and all the sector rallies together, and all companies are basically moving upwards. But if you really want to stick with the outperformers, the companies that will not go bankrupt no matter how brutal the situation is, they can always raise money. Their management team knows how to conserve capital. They have access to the best mining deals on the planet. If you stick to them, normally on a 5 to 10 year period, they're incredible fortune makers. But you can't force this. It can happen in 1 year, in 2 years, in 3 years, or it can happen in 5 to 10 years. They're so small and they're so volatile that you cannot predict their timing at all. All you can do is make sure that you buy them on the cheap and wait. Think about them as you would with a private business, that it takes sometimes 5 to 10 years to see a big payday with them. So that's kind of where I'm leaning with my answers to your audience. Gold and silver, important as an insurance policy. If you want to make an insane amount of money or a small fortune, depending on your starting point, then you have to have a 5 to 10 year outlook with these markets, especially in real assets or commodities, where they've suffered from a very brutal bear market for 7 years now and are just starting to find that bottom. Companies are becoming becoming healthier. The large companies, the large miners are starting to raise dividends and attract institutional investors, and the market is just slowly starting to turn around.
Sure. Excellent. That was actually a great overview. So there, with that, I'm going to jump to cryptocurrencies because,
okay.
you know, we're talking about assets that you use to hedge against the system. Cryptocurrency seems to be an evolution of the monetary system. So I'd like to get your take on cryptocurrencies. Are they an uncorrelated asset, or are they correlated? Because we see, you know, sometimes when the market goes down, the equities market, you see cryptocurrencies come down simultaneously, but at other times, there's been a few brief moments where they've been uncorrelated as well. So I'd like to first, you know, get an explanation from you what cryptocurrencies are, what type of allocation one should do to cryptocurrencies, and then I'd like to specifically talk about a few cryptocurrencies, such as Litecoin, Umisigo, EOS, you know, and Neo, just to name a few. But I'd like to get your take on it.
Well, first of all, I think that cryptocurrencies is a misleading name, and most of these projects are not aiming to be currencies at all. But the real revolution here is in the financial technology. So I overnighted a signed document from Zurich to Vancouver. And it's unbelievable that that signed document got there before I wired electronic money from Zurich to Vancouver. So the financial industry has frozen on so many levels that it needs a real shakeout in terms of how good it is, how modernized it is. It's unbelievable that you need to call bankers to facilitate some trades, and over the weekend they're closed, and they have their operating hours, and all of these things that in other industries, you know, you send an email, it's instant. Why can't you send money and it's instant? And so cryptocurrencies in all of these projects, all these digital projects are basically breakthrough projects to make the world more efficient, more global, faster, and more digital. It has its risks, obviously, because if something is only digital, it has only a digital version, and it's wiped out, then it's wiped out. So there are risks to digitizing the world. But on the flip side, what's very unique about the blockchain is that you can't wipe history. It's not like a centralized event where it says a server and then you see that your history has been wiped out. So I think it's important to understand that cryptocurrencies are technologies. They're not currencies. Bitcoin is not a currency. If it was a currency, then it wouldn't be evolving every day. It's technology. It's evolving. That's what it is. So you need to understand this. If you understand technology, if you understand how markets work, what markets want, and what markets need going forward, then you can invest in the right projects or the right technologies. And people who have done that obviously have done very well in 2017. Wealth Research Group was covering Bitcoin at $400, Ethereum at $12, Monero very early on at $19, Litecoin at $20, Steam at about 25 cents, and Ripple at 27 cents, about 2 hours before it started rallying to $3 on a fluke. Look, cryptocurrencies can be an amazing trading vehicle and speculative trading vehicle, but you need to know what you're doing. And obviously, with something that is currently very untested and therefore uncorrelated, and I can talk about that, it's not fully uncorrelated, but obviously much less correlated than other asset classes. It's important to understand. If you understand that this is a tech sector and a breakthrough tech sector that's having both regulatory issues, other issues in terms of technology, and it's not scalable right now as much as it needs to be. and that the way forward for it is incredible. It's very promising. Then you'll be able to figure out how much money you want to risk, which projects you want to risk it with, and what's your outlook on this. But personally, I am a very big investor in cryptocurrencies and cryptocurrency projects, and also in the stock market companies that are related to the blockchain technology itself.
Now, LIOR, are we in a bear market for cryptocurrencies, or is this just a regular behavior? Because I myself have been in cryptocurrencies since about 2016, and by this cycle, I'm basically conditioned on downturns. But a lot of newer investors essentially tend to panic, and especially in these extended periods of consolidation. So I'd like to get your take on where you see cryptocurrencies going in 2018, and then we can talk about specific currencies and ERC20 tokens and projects as you mentioned. I'd like to get a little bit of your take on each one of those.
Well, let's start with 2018. Cryptocurrencies are not in a bear market. They move in such a way that they can plummet or soar in a non-traditional time span. So they move in dog years, in other words. They can go down 60 or 70% in 1 month, and it's not even a CNBC story. If the S&P 500 was going down 60 or 70% in 1 month, it would be the end of the world.
Absolutely.
So to say that they're in a bull market or a bear market is not right words to use with them, because they can go down 70% and then they can go up 50 or 60% in terms of days. So the time span with them is very different. It's because they are going through this situation where they're in birth pains, so they're in growing pains. In 2018, I see two major events that have to do with cryptocurrencies that will have the most impact on them. So regulation is mostly priced in right now. All the problems that have to do with regulation, that's probably what caused a lot of the selling in January and February. What I think going forward is important is, one, will there be a project that is able to interconnect all these different languages, all these different blockchains, so they can move data from one blockchain to one blockchain and create a seamless environment? If that can happen, then all these projects are worth much, much more than their current worth, and I see them repricing to the upside. I think the euphoria that was in Q4 2017 will not return soon, okay? But it doesn't mean that Bitcoin can't double, or that the major product can't double. Doubling in this space is nothing for these currencies. Their volatility, their standard variation is very large. So doubling is or going down 50% is not a big event. So the project that will be able to interconnect them in itself will become one of the most valuable projects. And Wealth Research Group, in the newsletter, we're going to cover a few of the candidates very soon. So if you're a subscriber to the newsletter, you're going to see our updates on this. And the second major event is what's going to happen when central banks will start buying cryptocurrencies, because obviously if this increases in market cap and becomes $1 trillion industry, central banks cannot afford not to hold some reserve in cryptocurrencies, and that is going to change the entire industry. It's going to move mainstream people into this, institutions into this. They're going to require that commercial banks go into cryptocurrencies. That's going to change all of the environment, Faisal. So these are the two major events to think about and to track going forward. And we're covering them in full swing at the Wealth Research newsletter. Yeah.
Now, LIOR, do you see these events happening in 2018, or do you think it's more of an extended? Because obviously one can't predict the exact timing, but the momentum that you see building up.
It could. There's definitely projects out there that are advancing what we call basically interconnectability, or just creating a situation where there's no language barriers. And we do see a lot of interest going from the Bank of International Settlements issuing letters out to central banks and commercial banks on what they think about cryptocurrency. So it's definitely being talked about at the higher levels.
Mm-hmm. Yeah, and we saw J.P. Morgan and Bank of America come out with their own respective opinions on cryptocurrencies. So it seems like definitely it's more financial institutions are looking at this as a serious asset, or at least it's on their radar. So it's definitely previous times. What are your thoughts on my understanding of cryptocurrencies? I mean, I see some as deflationary cryptocurrencies where they have caps, and I see others as inflationary, such as Ripple and Stellar. What are your thoughts on Litecoin? In terms of where it is today, is there still a lot more further upside on Litecoin? Similarly, I want to get your thoughts on EOS as well, and as NEO as well.
Well, for Litecoin, for example, it's fighting against all the other currencies that are supposed to be, first of all, a fast, cheap, and easy to use medium of exchange. Right. And therefore, if it continues to be the better competitor, then yeah, it could be an important currency going forward. But does it have an important strategic advantage over Bitcoin, for example, if Bitcoin was able to sustain lower fees and scale? Not so much. So it just depends. It depends. As I said, these are technologies, and the development teams, what they do is what's important going forward. So it's all speculation whether which development team can help their community the most, and then we'll see who's the winner at the end of this race. We certainly don't need all of the cryptocurrencies that are out there because they overlap with each other, and so I don't see a situation where they all coexist in about 4 to 5 years.
Sure. So yeah, and in the short term, it seems like there's different attributes that if they meet those milestones, their adoption rate could be higher in terms of usage. And like you said, it's a technology, so it's a competing platform. I always keep doing the analogy with Netscape that it was a great search engine until Microsoft started implementing Explorer, and basically it just whittled away with time. So similarly, you've got different projects that
Exactly, just the competitive markets doing the thing.
Absolutely excellent. What about these payment gateways? What are your thoughts on payment gateways such as Omisigo? Do you see a huge market for these gateways out there?
Well, I'm not as big as an expert on Omisigo as to share something that will bring value to the audience. So I don't have anything to comment on that is too substantiated.
Sure. Okay. Give us some tips on some cryptocurrencies that you think are viable, or at least interesting technologies.
Well, we put out 2 special reports at the beginning of the year. One is called wealthresearch.com/top1, top and the number 1, and the other one is top and the number 4. And those are basically our top altcoins for 2018. We see the banking sector is very much obsolete, and therefore one of them is a way for banks to transact in a much faster way. And I think that kind of a project will absolutely be an important one going forward. Mm-hmm. And so, look, I'm
Ripple or Stellar? I mean, are you referring to?
That's Stellar. Yeah, that's Stellar. What I think is important to understand is, for me as an investor, I don't put my emotions into it. So I hate banks, but it doesn't mean that I think that the banks will go away. So if I don't think that the banks will go away, I shouldn't bet against them with my own money. So I can verbally say I hate banks, but it doesn't mean that I won't invest in a coin like Stellar because it helps banks evolve and get into this world. It's the same thing with other investments that sometimes people shy away from. They say, okay, I'm not into meat, so I'm not going to buy any company that produces meat. Fine, but you need to understand that that is something that that is not a pure financial decision. For me, I try to make sure that I go with pure financial decisions, and I keep my my own opinions out of what is purely mathematical and economical for me to do and for my family to enjoy. I'm sorry, it seems like you wanted to ask a question.
No, I mean, I was going to second your point that I don't, I mean, um, a lot of people in the crypto realm do tend to believe that, you know, banks will be disrupted entirely. I don't see that happening either, because they're an important component of the system. And I think they're going to evolve, you know, maybe potentially the SWIFT system may be upgraded, as you said, to one of these other currencies. But it'll be the entire population is not going to switch entirely to cryptocurrency overnight. And it'll be a gradual parallel system. So banks will adopt, and cryptocurrencies will have to link in with them and work together.
Faisal, you know, we're in a free market society. If people hate banks so much, then, you know, raise money, start your own bank if you think you can do a better job.
Exactly.
You know, it's just important to understand that evolution comes not from just complaining on something. It comes from offering an alternative solution. We have 4 other projects that I think are very important to this economy. I think, Faisal, going forward, many of the people who bought Bitcoin or these other coins for their anonymity, they will want to move into the full anonymous coins or the full anonymous projects. And therefore, one of the top 5 coins for us is one of the privacy coins that we feel is currently under the radar and undervalued. And we're actually going to come out with 3 new ones that are very, very small. They're not even in the top 100, but we think they have what it takes to become important projects going forward. And what I like about them is that they're niched. They're not targeting the entire cryptocurrency world. They target specific clients. And remember, you don't need all the world to be in your network effect for this token to become important. It's not like every person in the world owns Apple stock, but Apple has been, you know, an incredible investment, right? So you don't need all the world to be a part of your network effect for your coin to flourish and to become a major player. So yeah, I definitely think overall that 2018 we'll see altcoins and many of these good cryptocurrencies become a much more important part of the investment world. And if those 2 events occur, central banks going into them and a better way to talk between blockchains, then this is going to be something that's very productive for the entire sector.
So could we see another year like 2017, or do you think that was a bit of an anomaly with all the euphoria at the tail end? Which seems a little bit, you know, it was euphoria is the way to describe it.
Well, you know, you never know, right? But it looks and feels like people are far more cautious right now in terms of entering the space and just speculating, because the euphoria came in out of speculation and not because of real need to use these cryptocurrencies. People bought them and just held onto them because they thought that their price would be higher in the future. And it's still very much an open question with, hey, will the price keep rising or will it ever stabilize and just become a more stabilized currency? So these questions are remain to be seen, and that's why I love under the radar coins, because they can have their own little euphoria without the entire sector being euphoric.
Absolutely. Excellent. LIOR, in the end, I'd just like to get a brief summary from you in terms of portfolio design. There's all these various asset classes out there, but for the average investor, what type of percentages would you recommend in, as you said, in precious metals, in cryptocurrencies, in bonds, in equities, even mining stocks? If you're designing a ideal portfolio, how would you structure it?
Well, my main focus would be cash flow. And so with about 70% of your net worth, I would be in cash flowing assets. This is personally what I'm doing. Some of it is in cash flow dividend companies. Some of it is in options, and the rest of it are outside of the stock market altogether. It's in private lending, and it's in residential real estate. If you don't want to become a landlord and actually work another portfolio like a real estate portfolio, then stick with the stock market only and just get exposure through REITs, which are real estate investment trust, to the real estate market that way. A one-stop button, and you own a portion of a real estate portfolio of a publicly traded company. But 70% should always be in cash flow. That is what works. Don't try and invent the wheel, because you don't need to. You don't need to reinvent it. It's working. Cash flow is king at the long term. Then with the rest of the 30%, most of it should always be in cash to allow you liquidity, to allow you confidence and safeguarding of your life in terms of, hey, if I need something. If I may be more detailed, I have an emergency fund, which is like a startover fund. If everything goes bad, all my businesses, all my ventures, everything else, I have about 12 months worth of income outside of the banking system in cash, like physical. And if anything ever happens, that's my startover fund. So that's where I would start.
And that's it with top of the 24-month gold and silver?
Yes, just cash. Like duffel bag cash, right? You should do your own due diligence, what you want to do, how you want to do it. But yeah, keep it outside the system. You never know what's going to happen. You never know when you're going to need it. You never know, where everything will go. Obviously, your best scenario is you never use it. But who knows, right? Why risk your life with something why risk something as important as your livelihood? And then, I take 2 years worth of precious metals and I put that aside. Those are basically my chaos edges, right? Mm-hmm. I actually have a second passport as well, and I have these precious metals in 4 different vaults around the world, just to have more diversification in terms of geography and political events. Mm-hmm. And that's enough for me. I think that allows me a lot of leeway and flexibility, and a lot of parachutes opportunities in terms of if something ever happens. But if something does not happen, 70% should be in cash flow, about 15 to 20% should be in cash, and then the rest of the 10% should be your play money or your high risk money. You can allocate between these asset classes as much as you want, like cryptocurrencies, like the commodity sector, or the mining sector. I love the cannabis sector as well. And I love, I'm getting into right now, Wealth Research Group is pivoting also into technology. So very high tech stuff, artificial intelligence, like very futuristic companies that have either a breakthrough or not, but we're doing almost a year worth of work now into finding out the key players and the key projects. And with that look, that's 10% of your net worth. If you do it correctly, then and you find the right companies, that can become a very big part of your portfolio. But you should always keep it at 10%. In other words, if you make great returns in your play money, sell and allocate it into the safe environment and keep that always at 10%. Never lose sleep because you bought a company that may or may not pan out. And so that's where how I feel that that people should treat this.
Sure. That, I think that's a wonderful allocation recommendation.
Hey, Faisal, if I may, what's important for people to understand is that investments are so secondary overall in your life that in terms of how much effort you need to put in them, it is so minuscule in compared to the amount of time you should devote to your career or to your main active business. That's where wealth is generated and created. You know, investing has made very few people rich. Warren Buffett is not a rich investor. He's a rich CEO of Berkshire Hathaway. It's important to understand that it's not his own money that made him rich. It's the partnership's money that made him rich because he was able to create an investment vehicle. Same with hedge fund managers and all of these people that are multimillionaires, 100 millionaires, even billionaires. Most of them have done very well in businesses. 75% of the world's billionaires are real estate entrepreneurs. Mm-hmm. You know, okay? So it's important to understand your main focus in your life is to grow your active income, your career or your business. And then the rest is just to grow your savings into wealth. So just important to remember that and put everything in perspective. So people don't think that, hey, I'm going to use that play money. I'm going to become very rich with 10% of my net worth. It could happen, but you're more likely to put in the effort in your main career, to put in your effort in your business, and live a better life that way.
Excellent. That's sound advice. I think that's investing is important, but I think also focusing on wealth generation and generation of assets is equally important through focusing on having a very focused approach. So I agree with you there. LIOR, thank you so much for your time. I really appreciate this, and I think you've given a wealth of knowledge to our viewers. And I hope to have you back here again in the near future to continue to get updates from you. Again, sure. I'm going to put a link for your website below this on the YouTube link. So I hope everybody checks out LIOR's website. It's very informative. I've been following it for over 2 years, and I've gotten some amazing pointers. So it's been excellent. Again, thank you so much for your time, and look forward to speaking with you again.
Thank you very much, sir.
Cheers.